There's always something I forget to do, so I just push the record. All right. Uh, so what will happen is that I'll save this and I'll put a link to it so that everybody can take a look at it if they choose to. Um, so here, that first one, recall that a lot of the information is basically derived by looking at the transaction. Here you have no transaction to look at. So the first thing that you want to do, sorry, the first thing that you want to do, scary looking teacher, uh, is look at the accounts. So a payable, as we know, is something that we have to pay. So that's going to be a liability. We owe money on that. And then an expense is something we pay for doing business or cost of doing business. Revenue is a sale. It's money coming in. So, and then account receivable is something that someone owes us. When we collect it, it'll convert to cash and use that to help perform the things we do in the business. So that's going to be an asset. Common stock is the owner's equity. It's the share that the owner has in the business. We'll see, of course, later on the reality that many businesses, of course, are run by multiple parties. They could be partners or they could be shareholders. And then with dividends, this is what happens when the business pays money out to the to basically distribute earnings to them. So notice that in NCU the rules, or in general, it's not what will happen. And sorry. So as you see there, it tells us so the payable. If you want to increase it because it's a liability, so you see the increase on the credit side, and then if you want to decrease it, you debit it. So when you take on the payable, you're going to increase the payable and say to that particular customer that you owe them more. So that's an increase in the liability. When you pay it off, then that's a decrease in the liability. And again, remember we said these assets and liabilities and equity and revenue and expense all have a natural or normal balance, and that's listed in column C. So, any questions on that? So, if you had something called rent expense and you have to pay it, how would you show that you're paying more rent? And you just think about it from the perspective that, well, it's not on the list. I don't know what to do because it's an example, but it's an expense so that you know that it's going to be increased with the debit. And every month that we have rent expense, we're going to debit rent expense. If we have any kind of other types of expenses, utility expenses, salary expenses, we're going to use a debit to indicate that that expense has increased. Now it'll decrease as we pay them, so we know that the credit there is decreasing. So we want to be able to follow on these, and any kind of receivable. It could be an account receivable. Later on, we'll talk about notes receivable. There's all other things that other businesses have, so that when they have a receivable, it means that somebody's going to pay them. It is an asset that they're holding. They're going to convert it, of course, to cash, We're going to use that to do more business. So we have the idea that it's going to be increased with a debit because assets get increased with the debit and decreased with the credit. Now, the second exercise, it was to start to journalize these entries, and this is going to prove for some of you to be the most difficult aspect of the work that you're doing. So as you see there, it says we have these accounts, and then we have numbered them basically by the date. These are times of the month of June where these 4 transactions occurred. So the first transaction was to create the business, and that was done by the owner investing cash into the business and getting stock, common stock, which evidences his ownership of the business. And then we have equipment that is acquired because we need to get stuff to do stuff. So we spent $1,200 on the equipment. Again, look at what you got and what you gave up. Sorry, the margins, the formatting is not right, but so you see there that equipment is debited because it increased by 1,200. Accounts payable, we didn't use cash. We said to the other party that we'll pay them later. Accounts payable increased, and we show that increase with a credit of 1,200. And then as far as the June 1st, I'm sorry, when cash was contributed to the business, it became business's asset. And then when the stock was issued by the business, it became the common stock of the owner. So something that was increased, and we show increases in common stock by crediting. So that should be out on the right hand side around here somewhere. So what I do need to tell you right now though is that when you do this on a test, the you have to make sure that the 4,000 that anyway you have to make sure that it's out here on the right side because debits are on the left and credits are on the right. So debit left, credit right. So the 4,000 should be out towards the margin. For the common stock credit, the debit should be indented. One of the things that you're going to find is that in the beginning, the format is going to be very critical. So you will lose significant points on a test in the event that you do not put the debit first, as you see there with cash, indent the amount, and then put the credit second, flushed towards the margin with the corresponding amount, as you see there, right. So debit also equal credit, so the 4,000 and the 4,000 will be equal. Now these are simple transactions, and they do not require any kind of allocation. You don't have to calculate how much was involved. In the very near future, the problems and the test questions are going to be such that you have multiple entries, And the one thing to remember is that the debit side always got to equal the credit side, right? So if they don't equal, you know that you did something wrong. And then also remember that you have debits and credits for every journal entry. So if you get stuck, and many people will get stuck, at least put down something on that looks like it's an entry for a debit and something that looks like it's an entry for credit, and put it in the proper form where you see over here uh, cash, and then indented is the credit, right? So that that comes first on the left side. So this number here is the debit, and this number on this side is the credit. And now at least you get something for the format of entry. I will give partial credit for that, and that's something that may be the difference between passing and not passing. The next problem, of course, was we had a rent expense. Now remember I said that anything called an expense is going to, is an expense. Just take it for what it says. And it increased because we didn't have it before. So we debit the expense should increase. This time we paid for it with cash. So to reduce our cash, to make it less, we're going to credit. And you'll see here that that's the opposite effect of what you saw in the first transaction, where uh, the debit of cash, the asset, increased the asset. Here, spending cash decreased the asset. And then uh, the last entry that was given to us was the performance of something we sold. So we have a revenue. And then for that, the customer said that they'll pay us later. So we have an account receivable. The account receivable is an asset. It increased. So we debit accounts receivable 300, and we credit service revenue, which also increased for 300. So that was 2 and 3 combined. Sorry. And so 4, uh, this is something to just conceptualize. This is basically what we do when we make a recording. Um, First thing again is analyze the transaction. What happened? What did we get, or what did we give up? Did we get an asset? What did we have to exchange? Um, did we incur a debt? Did we incur a liability? And what did we get for, or how much was this liability? So we need to analyze the transaction. Um, so first, the other thing to think about is that in many instances, these transactions will be recorded on an invoice or a receipt or a contract or a lease agreement. So just to ask you something different, let's see. Let's see if I can get to talk to somebody. Uh, Josh, can I talk to you, Josh? You have to turn on your microphone. So there's a little icon on the bottom that looks like a. Oh, sorry, you're in the library. Okay, thanks. That's why the chat is good sometimes. Um, Jacqueline, Jacqueline, are you there? Did you just set your thing on a timer so that you just stay a little while and then when it's over you come back and turn off your phone? Uh, Jacqueline, how about Aki? Aki,
啊，你辛苦，在干嘛？你辛苦。
oh, somebody else is there. Interesting. Okay. How about oh, Ufa? Ufa, are you there? Robert? This is so much fun trying to make this interactive. Uh, sir. Oh, what happened now? Oh, internet problems. Okay, that happens a lot. I have those often as well. Michael, are you there? Okay, that's all right. So, I know some of you live out on your own because KCC has no campus housing, so that you may be renting someplace and you may have a rental agreement with a landlord because a rent for the privilege of staying in the unit that you're living in. So let's say instead that what you were paying was rent, but it was for a store. So this is where you do your business, or an office where you conduct your business. And every month you had to pay $1,000 for rent. And in commercial leases, unlike residential leases, it's much more common to rent a place and ask the person to commit to 5 years, sometimes less, but typically a 5-year lease in a commercial setting for a business is normal. So let's say you wanted to open a restaurant and you needed a location because you're tired of driving your food truck around. So you decide that you're going to go and you're going to rent a storefront and then you're going to set it up as a restaurant. And then you sign an agreement that says that you promise to be the occupant and the landlord promises to allow you to possess the property. And the terms are you will pay $60,000 over 5 years, and that will be your rent. So what you have essentially is then 5 years, 12 months a year, that's 60 months. You're paying 60,000, and then you are going to be paying that monthly. So that means that you can be paying $1,000 a month. If you have a transaction like that, you're gonna have to, and we'll talk about it, and you'll see how that's actually recorded. But you're only going to record for the liability and the payments the current year or the current period. So let's say that you rent the place and you open it in December, the last month of the year, and that's the first month of your lease. And after that, you're going to pay 59 more months. So in the first year, you paid for 1 month. We know that's $1,000. So your rent expense for December, your your first recording of this, is going to be a debit to rent expense of 1,000 and a credit to cash or rent payable or account payable for 1,000. So you're going to get a transaction like this that you'll have to break down, and you will not necessarily be um, told by the landlord or anyone else what it is that you're supposed to record, right? So you have to figure that out on your own, and that's what will happen at the test. Either that, or I'll give you a purchase order that says that you wanted office supplies and you wanted them delivered, and the office supply place said, okay, fine, it's going to be $1,000, and you get for that a receipt that says, or various list of supplies, amount paid or amount payable, $1,000, and I'll just give you that receipt of the test or a copy of that receipt, and then what you'll have to do is determine what it is. So unlike the problems where it tells you that the owner bought $1,000 worth of office supplies, what you're going to have to look at the receipt or look at the invoice or the purchase order and determine that that was a acquisition of assets of supplies. So debit supplies 1,000, and there was a liability or a payment. So if it was a liability, you didn't pay them yet, you're going to pay them later, you would have had a liability that increased. And then you would have credited that liability, or if it was instead a payment of cash, you would credit cash, the asset that was reduced to pay the bill for $1,000. Right? So it's not going to be the way it's set up in a lot of the problems. So you just have to look at it like this is what transactions really look like. And when you enter them, even if it's just entering them into like QuickBooks, if that's what you're using, then you need to make sure that you understand what numbers to put where. That's going to be so. I'm not going to just give you things listed like they are on the um, homework exercises. I'll give you notes, lease agreement, receipts, and things like that. Okay. All right. So back to the answer that's there. The second part is enter each transaction in a journal. So once you figured out what it was, okay, so we got cash, we invested it into the business, and we got common stock in exchange for that, and the ownership of the business. Then we journalize it. So we would debit cash for 4,000, and we credit stock, common stock for 4,000. And then the third thing, transfer journal information to ledger accounts. This step is called posting. Posting makes it possible to accumulate effects of journalized transactions on individual accounts. So now we're going to have a ledger for cash. So every cash transaction that occurs will be journalized first, either a debit or a credit, and then it will be posted to the cash ledger, and that will either be a debit or a credit. And this way we'll kind of know, like running a checking account, we'll kind of know how much um, cash there is because we will both have spent it and received it. So we'll have a balance at any time that we can look at and determine how much cash we have on a particular day. And again, that's going to be important information in running a business. So This is going to be what people will want to have if they own and run the business, or if you work for someone and you do these entries for them, they're going to want to know what the balances are. It's not uncommon for the owner to call you up or the boss to call you up and say, hey, how much cash do we have today? And you'll have to go look at the cash ledger and see what the balance in cash is, rather than waiting until the end of the month when you close all these entries and you make one big reconciliation. So businesses need information on a constant and ongoing basis. So these are examples of the debit credit transactions. I'll leave these to you to do. More here though of the journal entries that relate to this. So if you take a look here, cash got put into the business, so debit cash for the increase in cash, increased asset with the debit. Common stock got sent out, or basically the owner bought the common stock, and as a result we have a credit to common stock for 5,000. Again, I apologize, the formatting didn't carry over when I put it on the screen, but remember that the cash, the debit, is on the left, the common stock, the credit, is on the right, and that as you see the entries, you actually list them that way, so that cash, it is all on the left hand side, and then it's indented for the credit entry for common stock. Then we have something called prepaid insurance. So we bought this insurance in advance. Since we supposedly could get it refunded, that's the idea, but that's not necessarily true. But the idea is that we could get a refund for the cash that we paid for the insurance if we decide to cancel it. So since we could get money back, it's like having money in a bank, so that you could, ask for it later on, or you could get whatever's left after you made some withdrawals. So we have a asset that we create called prepaid insurance, and then we spent cash to get it. So we have a debit to the asset to show an increase of 1,800, and a credit to the asset which decreased. So we show a credit to cash of 1,800. When we do work here, it's a service business, so it could be like an accounting firm. And what happens is that we have service revenue being earned, and we get cash for it. So when they pay us the cash, we have an increase in cash. So we debit cash and asset to show its increase, debit cash for 1,900. And then we credit service revenue, which is owner's equity, to show an increase. So credit service revenue, increase it. Not owner's equity, I'm sorry, but revenue, the owner's revenue. So we credit service revenue by 1,900 to show the increase in the revenue generated. Then towards the end of the month, we have to pay employees. We see this here in the form of salaries and wages expense. We paid them $1,000. That's an expense because we pay them so that they can help us do more business and help us with our business. So it is an expense. It's increasing. We show an increase of expenses with a debit. So we debit salaries and wage expense for 1,000. And then cash is what we use to satisfy the wages. So we paid our workers in cash. And here the cash we paid was an asset. It was reduced, therefore we reduced the asset with a credit, so we credit cash for 1,000. On this exercise, what's going to be important to understand is that these are what we call T accounts. And T accounts basically show the transaction that occurred in that account. So as you see on May 12th, we received, or this business received, $2,100 in cash. So we debit cash for $2,100. Now, remember that for every debit, there's a credit. So there has to be another T account there that the first entry in that for this month on May 12th was a credit. So on the right side for 2100, and you can see it there under accounts receivable. So all debits equal credit, all debits equal all credits, debits equal credits. So when we have T accounts, you'll have two T accounts at a minimum affected by each transaction. So you have two T accounts at a minimum affected by each transaction because you have two accounts at a minimum affected by each transaction. So in this transaction, the two accounts were cash and accounts receivable. The debit was 2100 and the credit was 2100. We got cash, so our cash increased, so we debited cash. We gave up we gave up a right to receive that cash from somebody else, and we call that accounts receivable. So we credited accounts receivable for 2100. You can see the other things there. There is on May 5th in service revenue an entry that says we performed services. We charged 5,000, so we increased the amount of revenue. We show the increases in revenue with a credit. You notice that it's on the right-hand side of the T, so that we have $5,000 there. The corresponding entry was to accounts receivable. We did the service. The customer, the client, is not paying us at this moment, so they're going to pay us later. So we have a debit to accounts receivable, an asset that increased. So we're going to debit it for 5,000, and we show that on the left side of the T. Now notice at the end, there are ending balances, right? And notice where the ending balances are. Cash is an asset. The normal balance for cash is a debit, so you see it on the left-hand side of the T when we total it up. Service revenue is revenue, and the increases, the normal balance of a revenue is a credit balance, so we see the total on the right-hand side of the T account. And accounts receivable are also assets, and these assets, when we total them up, here we see that there's a plus and a minus, and then we see that the ending balance is 2,900, and that's on the left-hand side of the T account because that's where the normal balance of an asset will reside. Okay. So that's kind of like what I wanted to go over. I know it's this way is not as, unfortunately, as interactive because a lot of folks are in the library, and I don't blame you for not talking. Unless you have a Kit Kat bar like on the commercial and you break it off and give part of it to the librarian. You can go through the rest of these. There are only 3 more. I'll just roll through what they look like. And here we're looking at ledger accounts. This one is what's called a trial balance. In a trial balance, you put all the debits on one side and all the credits on the other side. Now remember, again, sorry for the formatting, but this is supposed to be over here, right? And then as you work through the problem, sorry, as you work through a trial balance, what you're going to see is that all the debits should equal all the credits. So this is every debit that was made during the course of the month, the totals, the reconciled amounts at the ending balances. Remember, cash, asset, normal balance, debit balance, so we expect to see the number in the debit column. Get down to accounts payable, a liability. Normal balance of liability is a credit, so we see that over there. And then we just add them all up. All the debits on the left, all the credits on the right. And our trial balance here is in balance, so we have the same amount on both sides. The total debits are 33,000 and the total credits are 33,000. A lot of times you won't necessarily get this right because something went in the wrong place. And if the problem was sequential, like start with the journal entry, analyze the transaction and make the journal entry and then post it to the ledger, and then it ended up being, okay, do a trial balance at the end of the period. If you didn't get all of the little entries along the way correct, then the big part of the problem, the trial balance, would be impossible to get correct. And here's another example of another trial balance. And notice that it is in balance because all the debits, which is all the numbers on the left-hand column, equal all the credits, which are all the numbers on the right column. So 45,800 is equal to 45,800. Okay, so that's pretty much taking you through Chapter 2 and the homework for Chapter 2. One thing I did also want to mention today is today we understand that like many things, they're not as they seem. So when you have Super Bowl 50, it's not Super Bowl L. And when they have Super Bowl 100, it's not going to be Super Bowl C. And when they have Super Bowl 3, it wasn't I. And what it was is the Roman numerals. What I'm getting to is that today the product launch for the iPhone 10 occurred. Apparently, the iPhone 10 is going to be selling for about $1,000, and that's more than any iPhone has sold for in the past, right? Because normally they sell for $300, $400, $500 in that range. So now you have an iPhone that sells for $1,000. I wanted to bring this up because we haven't really done much work with it, but we talked about it. The income statement. We said that if you wanted to increase how much money you made, you have to do one of two things. You got to sell more, or you got to have fewer expenses. So you increase your revenues, or you have to also decrease your expenses, or some combination of the two. Also mentioned something called a top line, which was the revenues. Can you grow your revenues? And one way to grow your revenues is to sell more stuff, right? But if you sell more stuff for the same price and the cost of that stuff is increasing, you're never going to make more money. So today's launch of the Apple 10 is interesting because what we see is that the revenue aspects are going to be enhanced significantly because they're selling the iPhone 10 for more than they ever sold another iPhone before. Now, we're not really sure about the expenses because no one ever tells us how much the parts cost. Sometimes what we do is we try to analyze what companies are making sales of the parts or providing services to assemble the parts, but we don't really ever get a picture of how much those parts cost. The only thing they tell us, because it's the only thing we're concerned about, is how much does it cost, right? If you would really like an iPhone 10, but you think $1,000 is too high, you're going like, well, I can't pay that much. Well, if the expenses to put the phone together are not that um, uh, big, then maybe it shouldn't be selling for $1,000. But at the same time, if you really want something, then you end up paying the money that they ask you for it, so long as it's not without reason, and so long as it doesn't make you have to not pay rent or not eat food, not drive a car. If you have the income, then you will end up buying $1,000 iPhone. I just wanted to mention that because when you think about these things as we do accounting, and I want you to think about things in the context of business, not just accounting, but business overall, we have to take a look at some of these things that are happening outside and understand that, okay, so they greatly increase the price. So that means that the top line, the revenue line, has a substantial possibility of growing. Now, just because we get more revenue doesn't mean that we get more money or more profit, because again, we don't know what the expenses are. So that's the other thing to think about, that just because they're charging $1,000 for an iPhone 10 doesn't necessarily mean they're making all kinds of money from it. Well, they probably are, because Apple's got this thing down pretty much to a science. And when you look at the product mix, the iPhone line has been responsible for over 55% of Apple's total profits. So, they're very successful at selling iPhones, and they sell very few products. Right? They sell an iPhone, they sell an iPad, and they sell a Mac, and a few other things, accessories or whatever. But the three products that they utilize, that they sell, which are the driving force, if not the only force of their revenue, the iPhone, the iPad, and the MacBook, are really something to think about. So we know that expense-wise, they probably did a pretty good job of controlling expenses. So they probably are making a lot more money off of the iPhone 10. That's going to cost around $1,000. So, this is something to think about. How do businesses get to this point? Now, understand also that Apple is the largest corporation in the world by value, right? Their stock value makes them the largest corporation in the world. So it's all information technology that they work with, right? They really don't have very many assets. So when we look at the balance sheet, yes, there'll be billions of dollars of assets, but in comparison to a company that's rapidly approaching $1 trillion, the physical assets really don't constitute that much. Let's say at one time, uh, Exxon, the oil company, was the largest company in the world. And you could understand that because they have oil fields, oil rights, drilling rigs, they have oil tankers, they have transportation systems, they have pipelines. So they had a lot of physical assets, tangible assets that you know that, well, if you had the money, you could buy those things. But I don't have that kind of money, so I can't buy those things. So I'll never be, that well off. But when you look at Apple, and then rapidly approaching Apple as far as valuation is concerned, is Amazon. These are companies that are founded on technology. These are companies that deal with intellectual capital, not cash capital. Remember, most of these things that we do are going to very shortly be done by machines. AI is going to take over. So what you really have to do is start to take a look at what happens outside when these things occur, because it's the information that you gather and your ability to use it. Now, I'm not saying that accounting is not going to be valuable. People like Tim Cook, who runs Apple, are still going to have to know a lot about a lot of numbers, but they are going to be in much different situations. So what's going to happen is we have to make sure we understand what's happening technologically, and keep up with those advances as they occur. And for class, of course, you got to be able to make debits equal credits. So it seems kind of hypocritical that in some respect I'm telling you that you have to make sure that debits and credits always balance, and you make the entries in the proper form and put the debit on the left and the credit on the right. And I know that many of you will be thinking, this is all going to be done by a software application. And really, it doesn't require somebody to input all of these numbers as their only job. Well, there'll still be some jobs like that, but it will really be looking at how do you use the numbers and what kind of things are happening that are affecting the numbers. So these are the kind of aspects that I will continue to emphasize throughout the course. We may not end up getting the best grades as far as the accounting tests are concerned, and that might right now make many of you not so happy with me, but uh, I think that there are other aspects of what we do, what we see, that are not written in the book and are not going to be tested immediately, that are going to be very critical to your success in the future. Now, remember, I'm an old dude, so I qualify for Social Security, so I can bail pretty easily at almost any minute. Um, you all are, for the most part, uh, a lot of you guys are going to be working for the next 40 to 50 years in order to make money to get the things that you need, like a house and food, your children's educations and things of that nature. So you got a long haul. So don't just memorize facts, don't just memorize answers. Start to think about really what's going on out there and how that'll affect you and how you can learn things, do things, and become skilled at things that are going to provide for you for the rest of your lives. So, anyway, thanks for putting up with this. I guess it works. So, that pretty much takes us through chapter 2. So, on Wednesday, I'll go over a few more things from the PowerPoint on chapter 2, just because I can, and then we'll start into chapter 3. And again, at the end of chapter 4, you should be expecting a midterm because we're going to go over 12 chapters. There are 3 midterms. So, I'm sorry, we're going over 13 chapters. There are 3 midterms. So, guess what? 4, 4, and 5 are probably going to be the amount of chapters on each of the tests. One other thing is the test will not be cumulative other than once you learned about debits and credits, you're going to be doing this in every accounting class that you ever take, no matter how much accounting you take. So you cannot forget about debits and credits and the debit credit rules. So if you don't get those down right now, then the rest of the class is going to be almost impossible. Please go see the tutor for help. Call me, or call me out after class, and ask me questions during class, and we'll try to get through this. But in the beginning, at least as far as the day-to-day administrative work of going through this class, as far as the basic preparation, once you get the debit credit rules down, then you're pretty much going to be able to function after that. Um, it's like anything else. It's like playing a game, and the first thing you got to know is how to run. Right? Because like when you think about sports, a lot of sports involve running. So until you could run, you probably couldn't be very good at any particular game. But once you got the running down, you always did it. You don't ask, well, coach, I already know how to run, so do I still have to practice running? And you know that the coach is going to tell you, yeah, you're always going to run, so you can never forget running. You can never stop doing running. So don't think of it in any other way as far as class is concerned, because these debit credit rules are always going to be with you throughout all of the accounting you take. And you got to be able to deal with that, and you have to be able to function uh, and have this thing down cold. Otherwise, you won't be successful in any accounting class, including this one. So as to the exams, no, they're not cumulative in the sense that I will ask you questions that were from chapter 1. It's cumulative really though in the sense that everything builds on something that you learned before, right? So the debit credit stuff is going to be on every test. The form of the journal entry will be on every test. Balancing so that all debits equal all credits will be on every test. And that's just the way it's supposed to be, right? Because that's what was supposed to happen. So we're going to work on those things throughout the semester. We got a little while to go, but I would imagine the first test would be in about 2 weeks. So we're going to go through chapter 3 on Thursday, and we're just going to keep going from there. Right? Did anyone have any questions? If you're in the library, you can use the chat feature. Thank you for being courteous for your other peers in the library and not participating. And then all the other people who were at home and didn't want to participate, you can thank all the guys that were in the library that said that they couldn't make noise because they were trying to respect other people's privacy rights and things of that nature and not bother them as they're studying. So you can thank them so that you didn't have to get called on to give any answers. I guess I will say one thing, that I should start calling on more people in class to do more of the discussion so that uh, you get more used to actually speaking in class and articulating your ideas. And for the teacher, it kind of ensures that you did the homework. Because if you can't answer the question, it's usually kind of obvious that you didn't do the homework. So we'll get more class participation going. I think we're about at the point where everybody is going to stick in a class, so we might as well find out who everybody is now. I never do icebreakers in the beginning because a lot of people in the beginning don't come back. So about halfway through the class is a good time to start introducing everybody to each other, because at least you know they'll still be around. You will have to do group presentations towards the end of the semester, and that's in the syllabus, and we'll talk more about that in class as well. Okay, so I better stop talking, otherwise I won't stop. So thanks a lot. I'll see you on Thursday.